The RCM Flexible Equity Fund is a South African equity fund with the flexibility to default to cash when value in equities cannot be found. The fund has delivered a compound annual return over the past 5 years of 4.8%. This against the fund's benchmark, the JSE All Share, delivering a return of 6.9%. For more, Pete Viljoen, Executive Director at RCM, joins us from our Cape Town studios. Pete, good having you on the show. Just looking at your cash holding July 2011 to July 2012, I see that has increased as a proportion of the portfolio. You're now sitting at just over 30%, whereas July 2011 you were sitting at 24.2%. Does that mean you think that there are fewer opportunities in the equity environment right now?
That's exactly right. The way we see the world out there today in South Africa, well, emerging markets in general and South Africa specifically, is value is becoming harder and harder to find. As global investors flee from developed markets, they are naturally attracted to economies with higher growth rates, such as emerging markets, Africa, South Africa. And the assets in those economies are being bid up to fairly high levels where we think the prospect of returns will be quite paltry.
I want to focus now on a couple of the changes we've seen in the fund from 2011 to 2012 beyond the cash element. And something like Telkom. If you look at July 2011, you had 5% exposure to Telkom. Now you've got nothing in your top 10 on that line item. Do you no longer believe in Telkom?
Well, we don't believe in very much at all. And in the case of Telkom, we have, over the past year, reduced our fair value calculations for that stock as the heavy hand of government has become more and more intrusive in its operations and its ability to generate free cash flow for shareholders. Our fair value has reduced. So to the extent it's reduced, we've sold our holding of Telkom. We haven't sold everything, but we sold most of it, and the market has done quite a good job of reducing our exposure to Telkom as well.
Exactly. I think yesterday I was looking at the share price. We were around about 18 Rand on Telkom. Will it start looking interesting to you again at these levels, perhaps if it trends even lower, or is it no-go area now?
Yeah, I think the problem with Telkom is it looks perennially cheap, but I think one can probably, in life you can probably bank on very few things, but the one thing you can bank on is for the unintended consequences of government actions to be value destructive all around, and I think that's what one is seeing in Telkom today.
Over the 12-month period, you've also reduced your exposure significantly with regard to Harmony. It did well for you. Did you take your money when it hit a certain level, and you've still got slight exposure on that front?
So in the case of Harmony, it did do fairly well for us. It acted the way it should be. When in 2008, 2009, when things were falling apart, it did reasonably well. We, over the past year, have been reducing our exposure to Harmony and at the same time increasing our exposure to platinum counters. So we're still in the precious metals area of the market, but we think the platinum companies who produce platinum, the shares of those companies have come a lot cheaper than those of gold miners.
The big constant in your top 10 is, of course, your number one play, and that is Sun International, still at 8.8%, slightly down from that, 8.4% now, July 2012. You're backing this story all the way?
Yeah, Sun International is a classic case of an investment cycle which we think is playing out very nicely. When we were hosting the Soccer World Cup in 2010, in the couple of years leading up to 2010, massive overcapacity was created in the hotel and leisure sector of the market. Hotels are springing up everywhere because people thought that the Soccer World Cup would create a lasting demand for hotel rooms, which of course didn't eventuate, leading to huge overcapacity in that market and the lack of pricing power for companies in the leisure sector, including Sun International. At the same time, we've been going through a global recession, which has impacted consumers' ability to spend money on the gaming table. So Sun International has been hit on two fronts, both on the leisure or the hotel side and also on the gaming side. So the earnings are currently under pressure. And what's happening in the market is capacity is being withdrawn. Hotels are being sold and closed down. So one can see the light at the end of the tunnel for pricing power to return to these businesses over time as demand grows, as it naturally does with the economy, and supply is constrained. So we see light at the end of the tunnel. We're very excited about the long-term prospects for companies in that sector. And Sun International still continues to be priced as if the war is going to end.
Pete, you also perhaps see light at the end of the tunnel for Amplats. It's been a discussion point on this news desk for many months now in terms of players trying to call the bottom of the platinum down cycle, if I can use that terminology. Amplats, you've got 6.3% exposure. Do you believe that we've seen the worst for the platinum stocks?
No, as I said earlier, we don't believe in anything. We have no idea. We have never been very good at calling tops or bottoms for that matter. All we can do is analyze the business of Amplats in this case. And our analysis tells us that one is not paying very much for the earnings power that Amplats has. You know, this is a company that controls a significant portion of the world's supply of platinum. The world's business cycle goes through troughs and peaks. At the moment is going through a trough. Demand for platinum, primarily from the motor vehicle sector, is at fairly low points. And Amplats and other platinum stocks companies are not earning very much money at this point. And the market tends to extrapolate current conditions. It's not that long ago where Amplats was trading at 1,500, 1,600 Rand a share, and the world was its oyster. It would continue earning lots of money forever. That was the thought, you know, at the time of the widespread belief in the commodity super cycle in 2007, 2008. Today, Amplats is priced at 400 Rand a share, and apparently it is never going to earn any money ever again. And we think the truth lies somewhere in the middle there. So when it was trading at 1,500, 600 Rand a share in 2008, we did not own it. And today at 400 Rand a share, we do own it because, as I said, we think the truth is in the middle somewhere there.
Do any of the other platinum stocks...
As to peaks and troughs, calling peaks and troughs, you know, we can't do that. There's other better people able to do that than us.
I should have known better than to say, do you think this is the bottom of the cycle? I stand corrected.
Look, Bronwyn, at the end of the day, you know, we are saying these resource shares are cheap, but I think at any point when you're saying certain assets are cheap and other assets are expensive, you need to understand why that is the case. If you don't understand why that's the case, you're like the guy at the poker table who is the patsy, who everybody's taking money off, if you don't understand why that's happening. So we think we've got a fairly good handle on what's happening out there in the market, and that is that investors are saying to themselves, we do not want to repeat the mistakes of 2007, 2008, when we lost so much money when markets declined. Because if you think back to that time, they were buying the commodity super cycle, they're buying the resource shares, and they were throwing out the financial industrial shares.
Just looking at financial...
Your financial crisis of 2008, 2009, the resource shares collapsed and financial industrial shares actually did fairly well. So what investors are saying today is we're not going to make that mistake again, and they're buying up financial industrial shares to very lofty levels, and they're throwing out the resource shares. So it's actually being set up for a reverse type situation.
Just looking at, on that point, your financial exposure, there's a dearth of it in your top 10.
Yes.
Obviously, July 2011, you still had exposure to Old Mutual. I'm assuming that did very well for you, as it has for
Yes.
many fund managers. You don't believe in the financial story now, just following on the theme in terms of what you've just said, you don't think perhaps something like an ABSA could start looking attractive?
Yeah, under new management possibly. I think what's happening, if you look at valuations, financial industrial shares today are trading at a 25% premium to the all-share index on a PE basis. Over the past 40 years, there's been two times that has happened. The one was in 1987, early 1987, and the other time was in early 1969. Those are the two previous times financial industrial shares were priced as high as they are today relative to the all-share index. And you know, you and I have both been around the market for a while. I don't need to remind you of what happened in those two instances.
Pete, always good chatting to you, as I said at the top of the show. Pete Viljoen from Reese